Welcome back, everybody, to the Financial Advisors Workshop. And this is the show where we interview some of the top financial advisors in America. And we search for folks that really are making a difference in the industry. And we talk to them and find out what they're all about and how they run their practice and how folks can benefit from their knowledge and their expertise. So today, from Massachusetts, we have Peter Disch, just like a dish, right? Just like a plate.
Just like the plate. That's it.
So Peter, you're a founder. You're in the industry now 22 years, but you founded your own firm at one point. So give us the background of how you started in the industry, and then lead us up to your current firm.
Sure. Well, thanks for having me, Brian. Happy to be here. So as you mentioned, I started in the business 23 years ago. And so we were the first graduating class after 9/11, and I was a finance major in college. There were no finance jobs available. So at the time, American Express Financial Advisors came on campus doing some recruiting, and I was interested in investment, and I wasn't necessarily thinking I'd be a financial advisor per se, but I thought, something in the finance realm. But again, it's kind of the only game in town. So I took the job. Basically, the first day I walked into that office, I knew I had to figure out a way to get out of there. And it was just some pretty hardcore sales training. And as you probably know, anybody can want to be a financial advisor, but if you don't have clients to advise, then you're not going to be doing too much. So first couple of years were really all about sales and cold calling and lunch seminars and all that kind of stuff. And I did a lot of that. I was probably doing, in a good week, 600 cold calls. That was 6 days a week, certainly Monday through Friday, Saturday mornings, Sunday nights, because of course everybody's home Sunday night. So we had our leads that came to us through the card program, and we were just dialing for dollars.
Nice. So that's the way it used to be done, right?
That's it. I mean, you could do it back then.
And yeah, can't really do that today as much, but yeah. So, all right. So you hard scrabbled your way up through cold calling and everything else. Then how did you lead to where you are now?
Well, so I didn't like the sales aspect of the job. I knew I had to do it. Really kind of did it out of fear and scarcity. But I always knew that I kind of wanted to be working with clients sort of in the more fiduciary model. I hated sitting across the table from a client, giving them a recommendation, and them in the back of their mind saying to themselves, all right, well, this sounds like a good idea, but what's in it for him? So at that time, when you're working with clients on their financial plans, kind of in the broker dealer world, there's that suitability standard. And basically what that means is that you can advise something to someone, and it's kind of like, it's good, there's good, there's better, and there's best for the client. And generally speaking, there's an inverse relationship with compensation to the advisor that's recommending that. Right. And so my thing was, number one, I always wanted to do the best for the client. Number two, I needed to make money. And number three, being a competitive person, I wanted to be kind of like at the top of the board for my group in terms of the production that we were doing. So it took me not too long to figure out that if you're just doing, the good stuff for clients and not the best, it's going to be a short career. It's not going to be very fulfilling. The flip side of that was that if you want to do the best thing for the client, it usually led to the lowest compensation to the advisor. I would just have to do somewhere between 3 and 5 times the volume that my colleagues were doing. So I really committed to that. I had kind of a seminal discussion with my father at one point, kind of brought him through the whole idea of the compensation structure versus what was really best for the clients. And he just looked me dead in the eye and said, if you ever come across a situation where you think there's something best for the client and the compensation to do something that's just good for the client is going to be something that you're concerned about, you tell me and I will write you a check for the difference. And when he said that to me, great parenting, great advice. And that was it for me. I was like, from now on, I am going to embrace this fiduciary model, work with clients in one way. And I started doing that. I was doing 3 or 4 times the volume, which in production just kind of kept me like in the top 10 or whatever, but would have been much more if I was kind of operating in other ways. My office was quickly changed from kind of the young, impressionable mind of advisors down the hall. And I just basically worked down there by myself for a couple more years, got myself to a point where I could go off on my own as a franchise of American Express. Got there for a few years. This was still like 2002 to 2005. And then I kind of started learning about how important like expenses are in portfolios and the drag and the impact that can have over the long run, which led me to exchange traded funds. In 2002, there were about $100 billion of assets in exchange traded funds. Today, that's pushing almost 10 trillion. So you can kind of see the growth, and that only happens for one reason. It's just, it's a far superior product. So even in that second kind of phase of my career where I was a franchisee, I was still making less money because I was paying so much to as a franchisee and using exchange traded funds. It didn't have any kickbacks or whatever because it's just pure expense ratios and not getting that 12B1 fee, that 25 basis points. The economics just didn't work for me to be anywhere else but to own my own RIA. So in 2008, 2007, I really decided. And then in 2008, I said, I'm just going to set up my own RIA. We're not going to do anything commission-wise whatsoever. We're going to be a true fee-only fiduciary to our clients. Opened up shop April of 2008. The 25 million or so that I brought with me quickly became 15. And that was baptism by fire once again. So I just got to work and I don't know, did that for a very long time.
So you started with 15 and now you're where?
In total, we're somewhere north of 600 million.
Very nice. And so in your practice, you run from 15 to about 500 of that, right?
Yeah.
Great.
That's
right. Good. So how did that happen? How did you develop?
So I made I bought a practice in 2009 that was about 60 million. So that was, that's kind of like where opportunity meets luck in some ways. But I was ready for it. And so I bought that practice. So that got me back to like 80 or 90-ish. And then from there, it's all been word of mouth and referrals. So we've grown completely organically since then.
Wow, that's great. Wonderful. And you have a few other advisors with you as well.
I do. I have 2 other advisors work at Great Point, Matt Schroeder and Brandon Parker. And our setup there is they have their clients and they are doing the financial planning and all the advice that you would expect. And then I run the portfolios for them.
Great. Well, let's talk about that. So Great Point is its own money management firm.
Correct.
And you're the lead manager. Tell us about your money management skills and then how it all works, different models and things like that.
Sure. So, we have a very principled philosophy of how we like to manage money. We think it's hard to time the market, whether it's, it could be good times or bad times. We think it's hard to pick individual stocks, hard to say whether Coke is going to be better than Pepsi. And so as a result, we just really manage money with a focus on timeframes. Most basically, if you think you're going to need some money in the next 5 years, we're going to put that into a safe bucket. If you think you can afford to not use that money for 6 years or longer, that's going to go in the growth bucket. We talk about your goals. If you're going to buy a house in 3 years, that's one conversation. If you're retired and you think you're going to need to spend 4 or 5% of your portfolio each year, that's a different conversation. If you're young and you just need to keep like a little cash reserve and the rest of it is for growth, then that's going to be a completely different allocation. We have models that are designed to accommodate any combination of those, really, because lots of times there's different things going on relative to the different accounts people have.
Excellent. It sounds like you're very flexible. Tell us about your models. Do you have growth models, international models?
So the way I think about it is, again, very simply, you either have money that you need to keep safe or you have money that you want to grow. So very simple. So we have kind of two buckets that I think about. Each of those buckets has 5 positions. So a completely well-diversified, perfect portfolio is going to have 10 positions in it. Each of those positions is going to be an exchange traded fund. Each of those exchange traded funds is going to target a very specific part of the market. When you put that together, you have a well-rounded asset allocation. Now, that conversation and the financial planning and the discussions we have with clients really is what drives the proportion of safe you have versus the proportion of growth that you have. But if you are 100% equity, or say you're 60% equity, 40% fixed, those positions that person has in 100% equity are going to be the same positions that person has in the 60% equity. They're just also going to have 40% of the fixed portion. And again, even within those two buckets, there's diversification across the different asset classes and, as it relates to fixed income, different credit exposure, different term exposure, so on and so forth.
Yeah, great. So, and is there a research bent? Are you more book value oriented or
Our approach, we start with the market portfolio. Okay, so we're going to own almost literally every security in the equity universe. We're going to start there, and then we are going to overweight towards value and profitability. And on the fixed income side, we're going to basically start with the entire universe. It's a much bigger universe than the equity universe. But there, because that's our safe bucket, we are going to tilt towards shortening duration and higher credit qualities.
Very nice. And what does the market look like right now on the fixed income side? Are you buying bonds?
Awesome. Oh, it's amazing. I love my fixed income portfolio. I hated it for 20 years. And I was just kind of configuring it throughout the fall and kind of implemented it this quarter. And now I look at it and I'm like, and I love talking to my retired clients about it because, their equities have done well, and, who knows what they're going to do. That's the whole point of equities, but they have done well. But now we can look at their 30 or 40% of fixed income, and it's amazing. I mean, they're getting 3-4 times the yield that they used to get. So it was a real opportunity cost over the last 15 years of that safety, real opportunity cost on, portfolio growth. And that's not the case anymore. We're able to get, depending what it is, 5-6% yield on a meaningful part of their portfolio. It changes everything. It used to be that I had to, kind of almost underweight the fixed income part of the portfolio. Certainly the last, say like between 2 to 5 years ago, because it just wasn't enough. And we had to, retirees for the last 20 years in a total return world have been forced into taking much more risk than maybe they wanted to. They had to do it in a responsible way. But, it used to be in the 80s, 90s. It's like, hey, you're going to retire. You got $1 million or whatever it is. You're going to go buy 5% CDs, spend 5% of your portfolio, and that's done. And that was just not even remotely attainable for 20 years, which in some ways, I guess I should be thankful for, because it created an opportunity for portfolio managers like us to put together thoughtful portfolios that could sustain that type of withdrawal rate without, earning 2% on CDs, spending 5%. And then, what people kind of usually don't know is that compound interest is a wonderful thing, and it can, it grows in parabolic ways. But once you get on the other side of that and you're withdrawing more than you're earning, it's a mirror image and your portfolio just falls off a cliff. And it's that old saying of, how do you go bankrupt? It's gradually and suddenly. And that's what ends up happening to portfolios that spend more than they make.
Yes. Well, that's great. That's awesome. Well, great. Well, thank you for sharing that with us, Peter. I noticed also, you've got some great credentials. You've been named in the top 100 registered investment advisors in the United States. You're best in state wealth advisor since 2019. You've been named America's top millennial advisors in Forbes in 2019. How did all this happen? And all these credentials?
Um, yeah, some of them caught me by surprise. Some of them, they reach out to you and say, fill out a survey. And, so I'll do that. And I don't know, it's been humbling. It's been exciting. But I think that a lot of it just goes towards kind of what we're doing every day. It's nothing, nothing, I don't think it's anything like groundbreaking, but I think that the model that we operate on, number one, which is this fee only fiduciary model, I think that has a heavy weight in how financial advisors are evaluated. We've had some years of excellent growth. So when people are looking at assets under management and things like that, I think it stands out. For that reason, I actually love bear markets. I mean, I know that's kind of like a 4-letter word, but that's the time that we actually grow the most. And then once that bear market turns, as it inevitably does, we just are growing off of a higher base. And since we're kind of always in the market and rebalancing in down markets, thereby accumulating more equity at cheaper prices, when things recover, some of those metrics, I think, stand out. And I think that's probably what happened on at least one of those recognitions that we received.
Excellent. Well, good. So that must be a great calling card when you go out to clients, and that probably has helped you grow your firm quite a bit. And as you built by referral, how did you get into such a high level of assets? You're at $500 million in your practice, and 600 overall as a firm. How did that work? I mean, you've got some very big clients, obviously, who've done really great work with you.
Well, it's just because of that. As I mentioned, I got my teeth kicked in doing the sales thing for 5 or 10 years. Again, had to do that. Hated it. I learned to love it, I guess, but don't want to do that anymore. So I have really just focused on, improving the systems that we have within Great Point. We're making things, basically everything that we do is about improving the experience of the client. And as a result of that, I think that's been reflected not only in referrals that we've received from clients, but also, and importantly, professionals that we work with, because there are, I don't know, 20,000 financial advisors out here. And, the accountants, the estate planning attorneys, they understand what we're doing. They get to see under the hood of how we're doing it, how we're responding to clients. And so they've been a great source of referrals for us also, which is, again, I just think a testament to what we're trying to do here. And super grateful for that.
Excellent. Well, good. So you seem to have a lot of experience, and you've done really, really well. What do you see coming on as the trends in our industry? Where are we going as an industry? What do you see, Peter?
From where I sit, it's very clear that there's a demographic change taking place with financial advisors. And I think we're in maybe like the perfect position for that, where we have 22 years of experience, probably have 22 plus years of runway ahead of us. And, they've got demographic changes taking place with clients And I think that we are going to be able to help a lot more people at scale. I think technology is going to be a huge part of that. I've always been a believer in technology. If I had to, it would be near the top of my list of how we've been able to grow and how we've been able to really help our clients is through the technology that we use at our firm. And we're just at the beginning of this J curve of artificial intelligence, which, my view on it is that if advisors learn how to harness the AI, learn how to use the tools to help their clients, they're going to have a choice to make. They can either serve the same number of people that they are now and work 10% of the time, or they can work the same amount of time they are and help 10 times the amount of people, or they're free to choose where on that spectrum they want to sit. And I really think that's going to happen.
Nice.
And I'm not sure where I'm going to sit on that. I know I won't do 10%. Not sure I want to do 10 times, but I think there's so many people that can benefit from this fiduciary fee only advisory model where you have somebody that's truly your advocate. You know exactly how they're getting paid. Hopefully you're happy to pay them because the return on your investment is multiples of what it's costing you. And I think people are going to begin to flock to this side of the advisory business. I mean, they already are.
We've already seen that as the
Right.
advisory is growing dramatically and the broker side is dwindling. And so you're a leader in that effort. And the public has figured it out that this is the place they want to be. So you're really good example of that.
Thank you. Try to be.
Yeah. Well, good. Well, what would you tell clients about investing at this point? Everyone says things are totally different now and markets are uncertain and everything. Do you buy into that, or is there any message you want to tell clients about generally investing and how to be successful?
It's again, the more things change, the more they stay the same. First of all, of course, everything's different. Everything's different every day. But if you have a principled approach as to how you are going to deal with the fact that things change every single day, then you have a track to run on. And that's really what we're trying to provide to our clients. So, my clients will tell you, they're not concerned about what the stock market's going to do next week or in 3 months or, in 3 years, right? If the market is bad for 5 or 6 years, sure, maybe we have a problem that we really need to start taking action on. But you want to talk about things that are different, go back to March of 2020. I mean, we'll be talking about this for the rest of our lives, like we will be with the great financial crisis, but it's a perfect case study in how to operate as a financial advisor or as an investor or a client. March, we're just getting slaughtered in the market. Markets are locked up. In some cases, you couldn't even trade, fixed income, couldn't do anything with it. So, I was able to reach out to all of my clients and say, hey, look, all right, we are like 2 weeks into this thing. And, we're all holed up in our houses and God knows what's going on. I said, we're 2 weeks into this. All right. You have 6 years worth of expenses built into your portfolio. Okay. So this would be like retired clients, ones that would be a little extra nervous. You've got 6 years worth of expenses in your portfolio. So why don't we give this thing like 3 months? Let's check back in then. Health was top of mind. Obviously, take care of your family, take care of your parents, your kids, whatever you got to homeschool your, all the crazy stuff. Let's check in 3 months. Okay, that sounds reasonable because even 3 months from now, I'm going to have 5 years and 9 months worth of money left. Who knows what the equity stuff is going to do? Check in with them 3 months later. It was like, whoa, we're like rolling in dough. There's just money being helicoptered from the sky, literally delivered into my mailbox. Everything was different. So having that plan in place and having that liquidity in the portfolio and being able to confidently say, look, we got short-term, high quality fixed income. Some of it's US treasuries, some of it's, you know, investment grade corporate bonds. And I personally might even in that environment, I might have rated higher quality than the US treasuries themselves. Look, we've got all this money. So deal with what you got to deal with right now. I'll deal with the money part of it. He's got 6 years. Let's check in. And yeah, it's created other issues to deal with, but having enough money certainly wasn't one of them.
Exactly. Oh, great. So to have a plan, no matter what. I mean, the world's falling apart, but still have a plan.
That was it. That's another learning that I had. So back when in my days starting out, we were forced to sell financial plans. And I hated that because here I am, 22 years old, just dying to get clients. And they might say, hey, you know, come across them. I got a $200,000 IRA rollover. Basically, I want it to grow over time. Then we were forced to sell them a $600 financial plan in order to take them on as a client. And I'm saying that nobody likes to get nickel and dime. And it could have been a 3-second conversation with a client to say, all right, you should be like 80% stocks and 20% equities. And that's your asset. We had to charge them if we didn't, we couldn't take them on, or we got paid like half of what we should have, whatever. So I kind of didn't like them. And then 2008, 2009 happened. By that time, that all that stuff was gone. And I was doing financial planning for my clients. Maybe I had a handful that I didn't. And I could call them during 2008, 2009. And instead of talking about, you know, the next big bank to go under or interest rates or whatever, we could talk about their financial plan and how their financial plan, if their goals haven't changed, their objective hasn't changed, and their personal/professional circumstance hadn't really changed, why would we change the financial plan based on the fact that the market's down? I mean, it was down a lot, obviously, but based on the fact that the market is down. So what I learned about that is that financial planning has almost become self-serving to me, a huge benefit to the client, but it makes my job as a portfolio manager, as an investment advisor, so much easier because I can point to that and relative to the portfolio and say, look, we knew stuff was going to get weird at some point in time in the equity market. And now it is weird, but your financial plan is still here. You're still doing the same stuff. So let's just let that portfolio do what it's naturally supposed to do. And that has been hugely important to not only making my life easier, but I think reducing the stress that my clients feel during these inevitable times of market calamities.
Great. I think the steadiness of it and the point that people need to have a plan and stay with their plan and don't lose your mind when things are bad.
That's it. I mean, that's the big mistake insurance that is like 90% of our value as advisors is not allowing clients to make that big mistake. And there are big mistakes being made all day long. It's our job to make sure that they are in a position to avoid those.
Nice. We've got some great ideas, Peter, and you built a great company and great practice. We're coming to the end of our visit today, and I just wanted to mention that about 300 advisors will see this near term, probably 1,000 over the next year or so. And if you had all those people in the room, like let's say you were in a big conference room and they were all here to hear what you had to say, why don't we imagine that you had them all in a room today? And what would you say to that group, that cohort today of everyone that's going to see this about success in the industry? Is there any major message that you can offer to our colleagues in the industry?
I think, I mean, my message would be one of extreme optimism. There is a huge opportunity coming our way. And whatever, there's a lot of different ways to run this business. There's a lot of different ways to be successful, to manage money, et cetera. Figure out what that is for you. Put the systems and the people and the infrastructure around you. Be consistent, be principled, and be ready for this wave of clients who really need our help. They really need our help, and they will be seeking it out, especially over the next 10, 15 years. And if you're inclined to do it the right way, and I would hope that the 300 to 2,000 advisors that were lucky enough to attend this conference are those type, you are going to have such an impact on the lives of these people, on the lives of their children, and it's super fulfilling. And I would just encourage you to really think critically about how your particular style is going to best benefit those people, and everybody's going to win.
That's awesome. That's a great message. There is tremendous opportunity in this industry to serve clients, and it's a service that folks need. And you're a great example of the best of our industry to do that. So thank you.
Very kind of you.
Thank you, Peter. And why don't we leave it there? We've come to the end of our time. Thanks everybody for being with us today in the Financial Advisors Workshop. And we learned some interesting messages today from Peter. We'll be back again with another tremendous advisor to discuss our industry and all the things that we love to do, working with clients, working with investing, making sense of all those difficult things that people try to do with their money over time. And thanks, Peter, for being with us today.
Thanks, Brian, and congrats on your success also.
Thank you. Thanks, everybody. We'll leave it there. Well, bye-bye. We'll be back soon. Thanks so much.